Netflix reported fiscal 2023 first quarter earnings after the market closed yesterday on April 18th. So what I'm going to do in this video is do a review of Netflix's earnings results, the big financial metrics that you can't miss from Netflix's earnings. And then at the end, I'm going to say if this earnings result make Netflix stock a buy or not or hold. Okay, so let's begin. So revenue increased by 3.7% in the first quarter to 8.2 billion for Netflix. Earnings per share of $2.88 was a decrease of $3.53 from the prior year. Now, if you look at this and you say, wow, these are pedestrian results from Netflix, you would be right. The company, ever since the first quarter of 2022, has been experiencing a major slowdown. That's when economic reopening really gained momentum and demand for Netflix's services fell off, right? It fell off. People were not as interested in streaming content anymore, and so it was having a harder time adding new subscribers, and some of the subscribers that it added during the pandemic were maybe pausing or canceling their subscriptions, right? That's understandable. They gained a whole lot of subscribers during the pandemic. Demand absolutely soared for Netflix and it thrived during the pandemic. It was just in the best case scenario, right? Because remember, while demand for Netflix was soaring and signups were exploding, at the same time, um, film production was on pause, right? Because remember, COVID-19 forced made it very difficult for companies like Netflix and others to produce content. So industry-wide content production was, almost zero for 3 to 6 months. So Netflix had this boom in customer demand, and at the same time, spending went to zero. So it had like this best of both worlds working, and it wasn't like competitors were also making content for Netflix to fall behind on content competitively. The whole industry was, not spending money on content. So everything was great for Netflix during the early stages of the pandemic, and now it's kind of moderating coming out of that time period. So it added 1.75 million subscribers in the quarter from the previous quarter. Netflix now has 232.5 million subscribers, the most out of any streaming company. You could say Disney has more subscriptions, but that's a key distinction to make because Disney has three streaming services: Disney Plus, Hulu, and ESPN Plus. Across those three services, Disney has more subscriptions. But if you look at just subscribers to a single service, Netflix is in the lead by a considerable margin. Free cash flow jumped to 2.1 billion. This was up from 802 million in the same quarter the prior year. That's really good news. So this is management's response, and from here on out, I think the next four bullet points, what I have is management responding to changing consumer behavior. Management responding to changing consumer behavior, and I like this. I like that management observed the rapidly changing consumer behavior and quickly made shifts to the business without letting it languish, right? Other companies, you will have heard me say, you know, management was slow to react or management did not respond the way they should have. I don't think that's the case with Netflix. I think Netflix management is responding, and I believe the response is measured, and I think it's working well. So let's take a look here. So free cash flow jumped to 2.1 billion. That's up from 802 million. Part of this is because Netflix reduced content spending. They said, hey, you know what? Consumer demand for our services is decreasing, so let's go ahead and decrease our content budget. Let's not spend as much money on content. At the same time, they increased prices and they rolled out some one of the next things they rolled out is paid sharing. So Netflix knows a lot of people are sharing accounts, right? Netflix knows that people are giving their passwords to their friends, their brother-in-law, their sister-in-law, their cousin, and all of this. So one paying account might have 6 or 7 households that's using it. According to management, there's as much as 100 million unauthorized sharing accounts going on. So if those were all paying, Netflix would have 332 million subscribers. So they're working on that. They're working on reducing that, and the implementation broadly of cracking down on password sharing, they pushed that back to the end, around the end of the second quarter, beginning of the third quarter. They've already started it in a few countries. They're going to more broadly roll it out second, third quarter. So you can expect to see some of those 100 million households that are now getting access for free, some of those will start paying for it. I don't know how many that will be. I don't know, let's say out of the 100 million, let's say 10 million decide to pay, and the other 90 million say, you know what, I didn't really like Netflix that much anyways. I don't mind if I don't get access, I'm not going to pay for it. But 10 million new subscribers could be added just from that password crackdown. And that's just my estimation. The number could be higher, could be lower. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Then management, after years of resisting, they rolled out an ad-supported version of their product, and so far that's going well. It's going well enough where management is considering wider availability, making it more available, adding new tiers of that service, and working around that because they noticed that customers really like that option. So they're rolling that out with greater availability. And so you start to see those 3 changes that Netflix made in response to slowing consumer demand. They reduced the content budget, they started cracking down on the people that are using Netflix for free, and they rolled out an ad-supported service to help with some of that when they do crack down on password sharing. If some of those 100 million households want to sign up, they now have a lower priced option in the ad-supported tier. So all of these 3 are, in my opinion, very measured and adequate response to the changing consumer behavior. And I as an investor, I appreciate this response. The company's forecasting second quarter revenue growth of 3.4% and earnings per share of $2.84, which would be down from an earnings per share of $3.20 in the second quarter of last year. So continued slow revenue growth for Netflix, and I think this is going to be the story for the rest of this year, is slow and moderate revenue growth and pressure on earnings per share, while management, shifts the company a little bit with these new initiatives and rolling them out, testing them, uh, seeing how consumers respond, and then making adjustments and then testing them again. So this is a an adjustment year for Netflix, and uh, so far I like the adjustments that they're making. And I had Netflix as one of my top stocks to buy in 2023, and after the first quarter's results, I would reiterate that. I think this is an excellent time to buy Netflix stock, and so far what I saw in the first quarter reiterated my confidence in the company. So that's all I've got for this video. Thank you so much for watching, and I hope you'll tune in again next time.